All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPIcks, and this is our options midweek updates. What we like to do with these types of sessions is we want to give you a glimpse into what we're seeing on our side as we go into the second half of the week. We're coming off of a holiday shortened week. We've had a very active market on the upside here the last couple of weeks. So I want to show you what we're seeing as far as support and resistance goes, some potential new trades setting up for the next few days. So we'll walk through a handful of charts here over the next few moments. As always, if you have any questions at all, feel free to post those here into the chat. If you're watching the recording on YouTube or Facebook, feel free to post a comment there as well, and we will get back with you as soon as possible. Let's go ahead and jump in. Last week was an interesting week because we have the holiday shortened week, but the shortened week was because we had markets closed on Thursday. It's always tricky when you've got a closure midweek like that, right? It does a number on volume. Volume was lighter last week. And when you start to see lower volume, markets tend to favor the upside. That's exactly what we have seen here the last few weeks. These markets have been relentless on the upside. They've just been bulletproof. Any type of news headline, any type of bad economic number, it does not matter. Markets are just determined to continue making the all-time highs. It's interesting because obviously we all know what's going on with the pandemic, all of the unknowns and how big of an impact the pandemic is going to have on the economy here going through this winter. The market just does not care. It just continues to plow its way higher. As a result, if we take a look at the daily chart of SPY, I always like to start out with this chart here because it gives us a big glimpse into the overall market environment. I do not use this chart to gauge entry and exit points. I use it to determine how aggressive I want to be. Do I want to use normal position sizes or do I want to cut back? Do I want to use more weekly options or more monthly options? And then do I want to just buy long calls, long puts, or do I want to use vertical spreads? Answers to those questions will depend on what I'm seeing on the daily chart, what I see on the internals. And I want to paint a picture here over the next few moments as to how I'm interpreting current conditions. No doubt about it, the bulls are in complete control of this market. I mean, you can see it on the chart, just on this daily chart of SPY. It's just been relentless on the upside. And what few moves to the downside that we've had, we have found support right at predictable areas. For us, it's the 8-period exponential moving average. It's that solid pink line that I talk about all the time in these sessions. If we go back over the past couple of weeks, you'll see 4 or 5 different cases where we tested that AEMA. Price action found support right on top of that level, and it just led to another springboard back up to the highs. In fact, we made a new all-time high yesterday. Until that level breaks on a closing basis, we are going to continue to remain in bullish mode, big picture. Just a probe below that AEMA is not enough. I need to see a daily close below that level if I'm going to get excited about anything on the downside. So that is our key level of support. It's currently sitting at 362.67. That is our level here currently. It'll continue to move higher as we go into tomorrow, but we'll continue to track that area as support. Down below that, we've got our 20-period moving averages. Both the green lines, they're both the simple and the exponential moving averages. Those are areas of interest should we break lower here going into next week. On the flip side, if we continue to grind our way higher, the high from yesterday is our near-term area of resistance. 367.68 is our new reference point on the upside. Should that level break, we're in uncharted territory. Our focus would shift at that point to the big round numbers, the 0.50 levels. So 368, 368.50. Those would be areas that we'd want to watch as areas of potential resistance. The volume, it's the last couple of days have actually been pretty active. The volume on SPY has been up above 70 million shares. It's a pretty good number. Long term, I'd like to see volume typically between 80 and 100 million shares. That's the sweet spot. And we're pretty darn close there. Volume has been pretty active. We have started to see that pick up here this week, which is completely expected, coming off of a holiday shortened week last week. I still have some concern with the ATR. We talked about this on the last few weeks. The average true range on the daily chart, you can see that it has steadily moved lower over the last couple of weeks. We have gone from over 7 on the ATR to down now below 5. I do not want to see that range contract because if it does, it just becomes more difficult as active traders. There's not as much range to work with. Things are slower. I want to be active. I want to be where the action is at. So I want to see that ATR start to reverse back higher. In order for that to happen, we're going to need to see some selling pressure in the very near future. The VIX continues to hang on to the 20 handle, but just barely. We're at 20.65 at the moment. Pretty unusual to see markets making all-time highs with the VIX above 20. I don't know if it's ever happened. In fact, we just continue to see uncertainty being priced into the options. We just have not seen any type of two-way price action at all. Now we want to see price action reflect that uncertainty. I want to see some pullbacks here on some of the key areas that I'll talk about next. The internals today, we did see some selling earlier in the session. We did get a gap lower this morning. The selling lasted all of about 15, 20 minutes. And we've basically spent the rest of the session grinding higher. Now, here's why I was not expecting any fireworks on the downside today. Even on the open, the internals were really not all that bad. The volume ratio here on both the New York Stock Exchange and the NASDAQ here in the upper left-hand corner, they are both positive. 1.82 to 1 positive on the NYSE, 1.5 to 1 positive on the NASDAQ. The volume that we do have today, it's favoring the upside. If we're going to see this market break lower, definitely need to see volume higher on the downside than the upside. We're seeing the exact opposite so far today. The advanced decline line on the NASDAQ, minus 248. Over on the NYSE, the advanced decline line, go ahead and switch the symbol here a second, is plus 186. Those are very mixed numbers. If we are going to see this market fall apart a little bit, start to see some nasty selling, we would have those advanced decline numbers at minus 1,000 at a minimum. We're nowhere close to that here today. This is not across the board selling. As this market tries to recover and head back higher, in fairness, it's not across the board buying either, right? It's a very mixed market, and this is very typical price action of a late stage move. You have a lot of tired markets here, and we're seeing that reflected in the internals. We haven't had a single buy or sell program here today. How do I know that? Down in the lower left-hand corner, we've got our tick chart. We have not seen a single plus or minus 1,000 tick reading there. So it's been very muted price action. And as I mentioned a few moments ago, when you start to see quiet markets, you start to see volume contract a bit, you'll typically see markets just methodically move to the upside. And that's exactly what we're seeing on the 5-minute chart, right? Here's your 15 minutes of selling right at the open. And we have spent the rest of the session moving our way back to the upside. So I want to see where we close this afternoon. For the sake of the rest of the month, I would love to see a break to the downside over the next few days. It does not have to lead to a crash. It doesn't have to mean the market's falling apart. I just want to see better activity. I want to see better two-way movement to work with instead of just getting this, one-way move where it's like watching paint dry all day long. I want to see the activity pick up here. So what is my takeaway from all of this? Looking at the daily chart, looking at the internals. Well, based on price action, based on internals, you have to lean cautiously bullish here, just based on what we've seen of late. But it does not mean you have to jump into new bullish trades now. What I mean there, if you're already in bullish trades, I don't have a problem holding on to those just to see if we can get, further movement to the upside. At this point on many of these markets, this is not a good area to initiate new long trades. You're chasing at this point, right? So cautiously bullish is my outlook. I'm actually continuing to look for a lot of credit spread opportunities, specifically selling out of the money call spreads, anticipating either a period of consolidation or a reversal in the very near future. So that has been my outlook here. Really, over the past couple of weeks, I have been leaning more towards the credit spreads, more so due to the expected slow holiday week. But I'm going to continue until we start to see better two-way action. I'm going to continue to lean on a lot of credit spreads in the near term. I'm also continuing to trade a lot of monthly options. Over the last couple of weeks, I've been talking to you guys about how we've been using a lot of December monthly options. At this point, those monthly options are down to 16 days left to expiration. Okay, we're now out of the window that we normally like to see. I want to see between 20 and 40 days left to expiration. My focus has started to shift out to the January monthly options. Those are the ones with 44 days left. Okay, could you trade any of these weekly cycles in here that have between 20 and 40 days left? Sure. Just make sure you're watching liquidity, making sure that you've got enough volume and open interest on the names that you're trading. Okay, if liquidity becomes an issue, you're certainly going to find better liquidity out in those January monthlies. What would cause me to shift my focus away from the monthlies and back to the weeklies? If we started to see the ATR uptick, if we started to see the volatility uptick a bit, if we saw better two-way price action, I would certainly be willing to look at more weekly options at that point in time. All right, so now let's narrow it down to exact entry and exit points. I'm going to go from the daily chart to the 195-minute chart. This chart will give you 2 candles a day instead of 1 that you normally get with the daily chart. Let's start out with SPY. Notice still, it doesn't matter the time frame, and it's just been an impressive move to the upside, no doubt about it. As a result, again, this is why I do not want to chase at this point. We have gone from around 322-ish back at the end of October all the way up to above 366. I mean, 367. That's a huge move for SPY. We're extended. We're overbought. How do I gauge the overbought conditions? I'm looking at my pulse indicator down at the bottom. The pulse indicator identifies overbought and oversold extremes. What I'm looking at there is the yellow bars represent price being between a 1 and a 2 standard deviation move on the upside. That does not mean SPY has to completely fall apart. It just means we're extended. The odds do not favor a continuation to the upside from here. In most cases, we've talked about this previously, when you start to see yellow bars in the pulse indicator, it'll typically lead to a sideways stretch or a reversal in the other direction. Just go back and look at the last few months. Anytime that we have seen yellow bars on the pulse indicator, both on the upside and the downside, it has led to reversals. Okay, you can see it all over this chart. Does it guarantee it's going to happen again in this case and reverse to the downside? There's no guarantees, but playing the numbers, playing the odds favor a slowdown here in the near term. When I say near term, I'm talking about the next week or two. I'm not saying that the high is in for the year and we're just going to fall apart going into the end of the year. Just in the near term, we're due for a pause. What I like to see ideally is 3 out of the past 5 bars plotting as yellow. Well, we've got that here. That gives me the green light to sell an out of the money call spread. I don't have a problem leaning neutral to bearish here, expecting that period of consolidation or expecting that pullback. One of the ways that we played that here yesterday, let me show you one of our overnight pop trades. This is a trade that we sent out to our customers yesterday afternoon, looking to put on a position going into options expiration. SPY does have a Wednesday expiration. Okay, so we were using the December 2 options. They expire at the end of the day. And what we did yesterday afternoon, because the market was so overbought, because we had those yellow pulse readings, we came in and we sold the 367, 369 call spread. So all that means is I'm selling the 367 call and I am buying the 369 call at the same time, making sure that we're in a fully risk-defined trade. I want to know what my maximum loss is before I ever pull the trigger on a trade. We collected 60 cents or $60 per spread on this trade yesterday. It tied up $140 of our capital. We ended up closing out of this trade here earlier this morning. We had that brief window up to the downside after the open this morning, and we closed out of the trade for 13 cents. Okay, that gave us around $47 of profit per spread, which you're looking at saying $47. That doesn't seem like a big return. Well, it is when you consider that we only tied up $140 of our capital to begin with, right? We're looking at a 30+% return on our capital, depending on your fill pricing. Okay, so really great trade. We close it out in and out of that trade in less than 24 hours. Those are the types of trades that we're looking to take advantage of going into expiration. Our focus now on the overnight trades shifts to Thursday afternoon for Friday expiration. And the neat part about that cycle is it opens up a whole new universe of products. We can trade any option, any stock that has weekly options. So it really gives us a ton of opportunity here towards the end of the week. And with so many chart extremes, there's going to be opportunity galore going into Friday's session. So really great trade there on SPY. But what if I wanted to initiate another trade right now? And instead of using an overnight trade like we just got done talking about? What if you want to go out farther in time? What if you're saying, all right, instead of being that aggressive with a 24-hour holding period, what if I wanted to be into a trade for a couple of weeks? You're saying the next couple of weeks, we expect more noisy conditions, potentially could expect a pullback. One of the ways that we can play that is to open up the January options with 44 days left. We are going to look at the out of the money call options, and I'm going to look specifically at the 373 calls. I'm going to those calls because they have a 65% chance of closing out of the money. You can see that I have the probability out of the money column shown on my trade page. If I right click on those options, go to sell and go to vertical, it brings up an order down at the bottom. By default, it has me selling the 373 call and buying the 374 call. I'm going to switch the long 374 call to 375. I'm going to stretch it out to a $2 wide spread. It allows me to collect more premium, gives me a bigger profit potential. This trade is currently pricing at 80 cents mid-price. If I click on confirm and send, it would leave me with a scenario where I'm risking $120 to make 80. It leaves me with 5 ways of making money on the position. I make money if SPY moves up, down, or sideways. As long as price stays below 373.80, we make money. That break-even point at 373.80, that is calculated by taking the 373 call that I'm selling, adding on the 80 cent credit. That gives us our break-even. All right. I also make money as time decay adds up, which it absolutely will. Every day that passes, premium is going to be sucked out of those options. That helps us with the credit spread. And we also make money if volatility decreases. So now I've got 5 different routes to follow to make money. I love credit spreads because they're more forgiving. Doesn't guarantee that we're going to win on every trade. We're going to have losing trades along the way. That's part of it. But when we start to see 5 ways of making money on the trade, these trades can recover much quicker, even on the trades that move against us initially. So do I give up the home run profit potential that I would have with just buying it a long put? Sure. But in exchange, I have a lot better odds of making money on the position. So the only move that hurts me is a move above 373.80, which we're not expecting because price is already overbought. In order for us to get all the way above that level, we would need to see new all-time highs, and we're just not expecting that in the near term. So that is one of the trades that is on my radar here for the next couple of days. Definitely like SPY and everything I just got done talking about. I mean, there's a whole slew of products that you can use with this strategy. There's overbought markets just about everywhere you look. Dollar Tree, symbol DLTR. Doesn't matter if it's a tech stock, doesn't matter if it's a retail name, you've got overbought conditions all over the place. Here on DLTR, you can see that on the pulse indicator down at the bottom, we have a whole series of green candles. That indicates that price is between a 2 and a 3 standard deviation move on the upside. Very unusual to see this type of extreme on the pulse. When I start to see this many green bars in a row, it provides a tremendous opportunity for either a sideways stretch or a pullback in the other direction, in this case to the downside. This is another call credit spread opportunity in our opinion. We've already got a trade on with a credit spread. You still have an opportunity here. Definitely love this one lower here over the next few weeks. If we take a look at some of the other index products, IWM, the Russell 2000 ETF, along with SPY, really been leading the charge on the upside. Okay, you can see it on, let me get some of this text out of the way so it's not distracting. So if we take a look at price, you can see all of the yellow bars on the pulse, indicating an overbought condition. What has happened since those yellow bars started printing? You can see we've started to consolidate sideways here. Doesn't mean it's going to break down, but this is a very typical pattern. What I'd love to see over the next week or so is for this 8 EMA, that's the red and blue line, I'd love to see it break on the downside and get a nice push. You got this air pocket down to our 50 period EMA, which is the yellow line. I would love to see IWM lower. I think that would, in the near term, if we can get that pullback over the next week or so, like I've talked about here recently, it would start to build energy for a more sustainable move to the upside. If we just continue to see this market grind higher every day, I think it's going to be more difficult to provide a sustained move. I think it's just going to be that slow grind higher. I'd much rather see a pullback first. So IWM is another short call credit spread opportunity. The NASDAQ ETF, symbol QQQ. We've talked here recently about how the NASDAQ was lagging behind. SPY and IWM did the hard lifting there for a couple weeks during this stretch right here, the stretch that I'm circling on QQQ. The NASDAQ took a break and never really pulled back. We just moved sideways there for a couple weeks. And now it built energy, and now we're starting to see another leg to the upside. As a result, QQQ is overbought. The pulse indicator down at the bottom, plotting yellow, indicating a very overbought condition in the near term. Any and all of the index products are fair game for call credit spreads at this point. Some of the other tech names, AMD, Advanced Micro Devices, it has also been on an absolute tear on the upside. We are now between a 2 and a 3 standard deviation move on the upside on the pulse. Very overbought, also looking for a pullback here in the near term. And when I say pullback, guys, a lot of times people misinterpret that. I will get questions on this quite a bit from people saying, Mike, look at the long-term trends. I mean, look at some of these tech stocks and look at these chip stocks. I mean, look at the potential that is there over the next year or two. I don't disagree with that. What I'm saying is in the near term, over the next week or two, price is very, very overextended. I would rather be interested in playing a pullback in the near term before another leg to the upside. So that's another one on my radar. Let's kind of shift our focus here. You know, it does not take much work to find call credit spread opportunities right now. They're all over the place. But let me shift our focus. Let me switch our trend strength histogram on. And let's turn the pulse indicator off. Our trend strength histogram down at the bottom. This is the one that we use for primarily for our directional type trades, meaning these are the setups that I'm looking at for the long calls and long puts. This trend strength histogram will flip across the zero line. If it flips blue, it indicates bullish momentum taking over. If it flips red, it indicates bearish momentum taking over. Notice what's happened on BABA. We have had the trend strength histogram go from blue to red. That happened here just over the past couple of days. Price action was also below both the 8 EMA and the 50 EMA. And once we saw the trend strength histogram go red, it gave us this little blue plus sign here. That is our entry point. If I bring up my data box, you will see that the entry point is at 262.97. That entry point was hit. That gives us the green light to put on a bearish position. Okay, the stop is up at our pink dots. The stop is at 273.78. So know where the stop level's at. And the reason why I wanted to show you this trade, a couple of reasons actually. I want to show the importance of being diversified. And I take a different approach to this. It's not just in the markets that we trade. Yeah, we want a good mix of stocks and ETFs, but I also want a mix of strategies as well. The short call spreads that we talked about so far, those are great trades. The long puts, it's a more aggressive trade here on BABA, but it's a great trade to have in our arsenal. I want to have a mix of bullish and bearish trades on. If I take a look at the overall market, you know, it's hard to argue with the fact that this market's been ultra strong. But that does not mean I can just ignore the downside, because when this thing does turn, it's going to turn in a hurry. We know how quickly things can change on the downside. I want to have a mix of bullish and bearish exposure on. I'll be the first to admit right now, my overall portfolio is leaning very bearish to the point now where I know I don't have enough bullish exposure on. I don't like when I get into this type of scenario because I'm almost one directional. Now, it's harder to find bullish trades at this point, as I already talked about, because markets are so overbought. But long term, I need to make sure that I get some bullish exposure on because I want to have a balance there. So if you find yourself 100% bullish right now, I would challenge you, get some neutral, get some bearish trades on just in case this thing does turn in a hurry. You want to be prepared for that. It's not that we're just trying to pick a market top here. BABA has already given us the green light for a bearish position. If I jump over to the trade page, switch this to BABA. I'm still looking at the January monthly options, the ones with 44 days left to expiration. And what I'm looking at here is either the 265 or the 270 puts. I'm looking at those puts because I want to get slightly in the money. I prefer to trade the in the money options whenever possible if I'm going to buy an option. Yes, they're more expensive, but you get a higher quality position. You get a position that's not all time decay, for example. So if we take a look at the 265 puts, they are pricey. It is a $260 stock. Volatility is elevated. So the 265 puts, they're going to run you around $1,450 at this point. With volatility elevated, with the VIX above 20, options are going to be pricier. That's another reason why I've been trading so many vertical spreads. Using a vertical spread is going to lower the cost of the trade by 30 to 60%. If you don't mind the additional risk, $1,450 per contract, that's fine. I have no issue with the bearish trade. It's just going to be a more aggressive position. You only have one way of making money when you buy a long put. That stock has to move lower and it has to do so quickly. All right. So that is another position. Baba looking for more of a bearish directional trade, potentially with some long puts. That is another trade on the radar here for the rest of this week. Some of the other areas that we touch on quite a bit here in these sessions, the financial sector, JP Morgan, Citigroup, Bank of America, they have all had very impressive moves to the upside. Let me turn the pulse indicator back on as well. You will notice that on JP Morgan, as the chart reloads for me, we've got all the yellow bars on the pulse. We are overbought in the near term. Right? So that gives us another call credit spread opportunity. One of the filters that we talk about with our customers is if you wanted to wait for price action to confirm before you sell a call spread, you could wait for price to break below the 8-period EMA. That's the red and blue line. I wouldn't have a problem with that at all if you wanted to wait for confirmation there. Bank of America, similar story. I mean, we're overbought. We're extended. Notice what happened to price over the last week or so. We've just been consolidating sideways in here. Very, very typical when you start to see this type of overbought condition on the pulse. We have the yellow and green bars there. We're extended. We're between a 2 and a 3 standard deviation move here. Doesn't mean Bank of America can't head higher. It just means it's not statistically probable. Odds favor this sideways pattern that has developed and would even favor a deeper pullback here in the near term. Energy. And when I say favoring a pullback, guys, on a lot of these names, I am more interested in credit spreads than long puts at this point. If you prefer to put on long puts, that's fine. I have no issue there. Just know that it's just a more aggressive trade. It's going to tie up more capital, and it's only going to give you one way of making money. Chevron, let's take a look at some of the energy names. Chevron has also had an impressive move to the upside. It too is overbought. And I'm doing this for a reason today, guys. I mean, what I'm showing here, the last number of months, we've seen a lot of sector rotation. The tech names are strong. Then they pass the baton to financials. Then they pass the baton to energy. And we continue to get this rotation between the sectors. We have not seen a stretch where everything is strong or weak at the same time. We're seeing one of those stretches right now where everything is strong. Everything is strong together. You've got energy, financials, tech, all of them are overbought. It's very typical of a late stage move. So I can't stress that enough. I mean, we're extended here. Doesn't mean we can't head higher in the near term. I'm not saying we have to reverse immediately, but in the coming days, next couple of weeks, expect there to be a sharp pullback on many of these names. It might not last very long. We don't need it to, but I definitely want to be looking for it. Want to be able to play it, and then also want to look for a reset for another move to the upside into the end of the year. So Chevron, no long put potential here as of yet because our trend strength histogram is still blue. We do not have a new short trade as of yet. If you're going to put a trade on any of these energy names, your better bet would be to sell an out of the money call spread. All right, the final one here on my list is Beyond Meat. This is symbol BYND. Much like Baba, we have seen the trend strength histogram go from blue to red. We actually saw price action the last week or so test the 50 EMA. That's the white line. That was a rock solid resistance. And we have since flipped back to the downside. Could very well see this thing fall apart a bit in the near term. So we do have a short setting up. My exact entry point on this one is at 134.21. I have to see that entry point hit first. If it is hit over the next couple of days, let's jump over to the trade page. I am going to stick with the January monthly options. Again, could you use the weeklies in here? That's fine. Just make sure there's enough liquidity there. I'm preferring the January options, even though I know I'm going to pay more for them up front. It just gives me a higher quality position. So I am looking at the 140 puts, plenty of liquidity, plenty of open interest. You're talking around $1,200 per contract on the long puts on Beyond Meat. I would want to wait for price action to first get down and hit 134.21 before I jumped into the trade. But if that happens over the next day or so, I would certainly be open to buying some long puts on Beyond Meat. Colvier asking what time frame. This is the 195-minute chart. This is our preferred time frame. We like it because it does a good job of identifying, number one, overbought and oversold extremes, but also some of the trending type moves. It doesn't get caught up in as much noise as some of the shorter term time frames. If you look at an hourly chart, a 30-minute chart, the problem with those is they can get very noisy very quickly. A lot of false breakouts at times. When you stretch it out to a 195-minute chart, we find that it identifies moves better, and it also reacts quick enough. If you go all the way out to a daily chart and only have one candle a day, the daily chart is too slow to respond and too slow to give us setups in most cases. The sweet spot for us is getting 2 candles a day, and that's what the 195-minute chart does for us. Yep, Mario, that's exactly correct. It is the 195 minutes. The other time frame that I will use from time to time, more so for my directional trades, is the 130-minute. Those are my 2 favorite time frames myself. And when I say that, I am looking for a swing trading approach. I'm not looking to day trade. I'm looking to take positions for a couple of days on out to a couple of weeks at a time. And those 2 chart time frames, 130 and 195-minute, they have just been rock solid for me for years now. All right, one last topic that I do want to touch on. I cover it quite a bit in here in these sessions, but it's come up quite a bit again the last week or so. And it's asking about how much attention do I pay to fundamentals and news and so forth. Because I fully realize, guys, I mean, there's a lot of things going on behind the scenes to prop this market up, right? They're now talking about another stimulus plan to help out with this whole pandemic. You've got a change in power coming up here going into next year. You know, with Biden taking over the presidency. There's a lot of that can potentially cause some unknowns in the market. Do I trade off of that? I do not. Do I pay attention to it? Sure. I mean, we're all human. We're all paying attention to the news, right? It's hard to avoid it these days. But I'm not trading off of that. I personally believe that everything that could be released on the news side of things is going to be reflected in price action on the charts. If I traded off the news, you guys see it. The news cycle has not exactly been stellar here lately, right? And yet the market doesn't care. It continues to move higher. If I were trading off of news, I'd be 110% short, right? And that would not be working right now. So the bottom line is I try not to be influenced by news. I try to base my decisions off of price on the chart, off of the numbers, statistics. I know I'm going to have winners, losers, and break evens. That's just part of trading. But if we can focus on the numbers, focus on the statistics, it just takes a lot of the other issues out of the equation. You don't have to get so caught up with the news cycle, for example. All right. One last thing here. We actually are doing, at the moment, we are doing a holiday special. We followed up the Black Friday and the Cyber Monday offers. We followed it up with a holiday special of our own. A lot of you have been joining us for these live sessions. I try to do a midweek update on Wednesday, and then I do a weekly recap, typically Friday afternoon. And you guys have gotten a glimpse into how we approach the markets at NetPIcks. I've shown you a lot of trades. I've shown you trades on the NASDAQ. I've shown you trades on some of the financials, some of the energy stocks. Everything that I talk about in these sessions is what we use with our customers on a weekly basis. We do that research. We send them the trade recommendations each and every week with all of the details on how to place a trade, when to close out of the trade. So all they have to do is piggyback off of our trades. we are offering just a phenomenal plan at this point, price points that we've never offered before. What we're doing is combining two of our most popular services. We're combining the NASDAQ Options Superstars program with the Simplified Options Superstars program. The NASDAQ service focuses on a mix of long calls, long puts, and a lot of vertical spreads. The Simplified Options Superstars program focuses strictly on trading long calls and long puts. It's a powerful combination. So what we're doing with this promo, I've put a link up on the screen. So if you go to netpicks.com/holiday 2020, that will go ahead and give you a link to a video that'll walk you through what does this offer look like, what's included, how does it work. So go ahead and take a look there. But what we're doing is we're combining the service. They're typically sold on their own for $9.97 for an annual membership. We're combining them into one membership for $9.97. So you're basically getting the second service free of charge. You're saving yourself $1,000. I will tell you, we only have a limited number of spots available. And as of this afternoon, we are down to our last few spots. But I know some of you have been joining us for these live sessions. Really appreciate that. So I wanted to make the offer available to you guys as well. So here is the link to the video. Take a look. If you have any questions, feel free to contact me. If you have any questions on any markets that I have not had a chance to cover today, feel free to send me an email, mike@netpicks.com. I'd love to connect and help out with any questions you might have. So I will jump back on here on Friday for our weekly update, our weekly recap. If you have any questions between now and then, feel free to let me know. If you have any last minute questions here today, go ahead and get those in now. Otherwise, I'm going to start to wrap up here for the day. Again, feel free to click on that link there, netpicks.com/holiday 2020, and we will go ahead and show you the special offer that we have going at the moment. All right, so enjoy your afternoon, everybody. I hope to see many of you back here on Friday for our weekly recap. We'll talk to you then.